Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sisi, your tutor and your mentor. Today, we are going to cover IAS 2, which is inventory. We are going to look at the accounting treatment for inventories. We are going to look at the recognition, and we are going to look at the measurement and how we can, calculate the value of inventory using the cost method, and also how we can account for the subsequent write down of inventory. According to IAS 2, inventory should be valued at the lower of cost or the net realizable value. Very important concept that we need to know according to IAS 2. Now let's understand the definition of inventory, which is very much important. And we are going to look at the definition of inventory into two broad categories. One has to do with the inventories that we can use to directly recognize revenue. Very important concept we need to know. We have a distinct categories of inventory that we can use to recognize revenue, and also we have categories of inventory that we can't use to recognize the revenue, but we are using these inventories to support the day-to-day operational activities, to increase on the production process, to improve on the efficiency of the production process or the services we are delivering to the client or to the customers. Very important. So now let's understand the first category of inventory which we can use to recognize revenue. For instance, if we are producing a pure water, the pure water that we can sell to our customers, we can use it, we can recognize it as a revenue. Now, if we are producing, let's say for example, Sierra juice, we need to put together the raw materials, we need to put together another, component of items that we can use to assemble a single bottle of Sierra juice, which we can sell to our customers. So the single bottle, the raw materials, another component that we are going to put together to fix up to produce a single unit of Sierra juice, we can classify them as an inventory. So for revenue driven inventory, it is very much important that we understand the concept according to IAS 2 and how we can account for inventories that we can use to recognize revenue. However, we have other generating, you know, revenue stream which we can't use to recognize revenue. Also, we have another revenue generating stream which are not tangible, but yet still we can use them to recognize, revenue. At the same time, they can be inventory and they cannot be inventory. Now, for instance, if we are talking about the audit firm do not sell any physical goods. So therefore, in most cases, their inventory will include the unbilled audit work. For example, if we are talking about the audit hours already worked, but not yet billed to the client. So at the end of the year, we can account for this particular work in progress, as an inventory for the audit firm. So this is just an example. Also, if we're talking about the tax, consultancy firm, it can be the same because they can't produce a physical and a tangible product. They can produce a service to their clients. So therefore, the work in progress, for the consultancy or the tax jobs can be classified as inventory. Also, we have other revenue generating stream which we can't classify as an inventory because if we are talking about the insurance company, the insurance companies do not have inventory under IAS 2. The reason being is that because they provide the financial services, not goods. So we need to note that point down. Then also the primary assets are financial assets and also the insurance contract. So for us to be able to, to understand the distinction between a revenue generating stream, which can be inventory and which cannot be inventory, it depends on IAS 2. Also, if we are talking about the banks, for instance, the banks also do not hold goods for sale. It's very clear. The banks do not have any inventory under IAS 2 because the revenue generating stream for the banks are the loans, advances, for example, investment securities, cash, and financial assets. These are all, revenue generating stream, but we can't account for them under IAS 2 as inventory. So therefore, we can use IFRS 9 to ensure that we account for the loans, the advances, the investment security, the financial assets, but we can't use IAS 2 to account for the loans, the advances, the investment security. So banks provide financial service, not physical goods. So IAS 2 does not apply to banks. So this is a clear indication and distinction for us to understand the concept of inventory. So now we are going to look at inventories that we can't use to recognize revenue. For instance, we are talking about the consumables. If you are working in the manufacturing industry or in mining mining, we have a specific type of machine that we are using in the manufacturing process, in the mining process. These machines, they have some unique spare parts that need to be always available. They are very critical, to the production process. So as a result of how critical these components, these spares are, we can classify them as an inventory, which are the consumables inventory. We are using these pairs to support the efficiency of the machine. We are using these pairs to support the efficiency of the production process. Without these machine spare parts, then it means we can't able to meet our production target, and it will affect the objective of the business. So these particular categories, we can classify them as consumables, which can be inventory, and we can account for it according to IAS 2. However, when we are going to look at the valuation, we are going to distinguish between how we can value for inventory that can directly link with revenue recognition and how we can account for inventory that we can't use to recognize revenue. So now, IAS to ensure that inventories are recorded at the value that reflect the economic reality and prevent overstating of profit. Very important concept that we need to know. IAS2 state that inventory should be valued at lower of cost or the net realizable value. So now we are going to look at the scope of IAS2, which is very important for us to understand. And IAS2 applies to all inventory except for construction contracts covered under IFRS 15 when we are going to look at the revenue from contracts with customers, and we are going to understand why we are not going to account for construction contract under IAS 2. Also, I talked about financial instruments. For instance, we are talking about the bank loans, the bank securities. We can't use IAS 2 to account for them. Instead, we can use IFRS 9, the financial instrument, to account for the financial assets as well as the financial liabilities. Also, we are not going to use IAS 2 to account for biological assets related to agricultural activity under IAS 41. So now if we're going to look at examples of inventories, we can talk about the goods held for sale, which are the finished goods. As I mentioned earlier, the Sierra juice or the pure water, the bottle of Sierra juice or pure water, it is the finished goods. Then we can sell it to customers. So we can account for it as inventory. The work in progress, we are talking about the raw material, the mango for Sierra juice, the mango, the water, the sugar that they are going to put together to to produce a single bottle of Sierra juice. We can account for the raw material as inventory. Also, when we're talking about the consumable, I mentioned it initially. These are items that we can't use to recognize revenue, but we can use them to support the day-to-day operational activities, to support the efficiency of the production process. Also, we are going to look at goods purchased for resale. If we're talking about the merchandise. So now let's understand the key definition, very important concept. And we are talking about inventory, assets held for sale in ordinary course of business. As I mentioned earlier, the business strategic objective, the source in which the business can generate revenue. That particular sale, we can account for it as an inventory. Also, we can account for it in the process of production for short sales. Very important. Then also, finally, in the form of materials or supply to consume in production or rendering of service. So now we are going to look at the net realizable value. And then when you're talking about the net realizable value, it is the estimated selling price in the ordinary course of business, less the estimated cost of completion and the estimated cost necessary to make the sales. So now, if you can remember when I talked about impairments, IAS 36, I mentioned that within the scope of IAS 36, we can't, you know, use the impairment concept for inventory as per IAS 36 because if we are looking at the valuation of IAS 2 for inventory, which should be valued at lower of cost or net realizable value, it means, for instance, if we are using the cost model to value our inventory, if the cost of a Sierra Jones is 10,000 leons, for example, then if the net realizable value dropped to let's say 9,000 leons, then it means we need to ensure that according to IS2, we recognize the 9,000 as the value of the inventory, as the value of the Sierra Jones instead of the 10,000. So, IAS2 encompasses the impairment already. So we don't need to use impairments again to account for the inventory. So now if we are talking about the net realizable value, we are looking at the estimated selling price in the normal course of business, less any other cost of completion or estimated cost to ensure that we make the sales. So now IAS2 stated that we need to use the lower of the cost or the net realizable value. So now we need to understand the costs. Very important concept. The cost is the cost of bringing items of inventory to its present location and condition. It can include the purchase price of raw material, it can include the conversion cost, and also it can include any other cost that we can use to bring that particular item to its present location and present condition. So we need to consider three factors when we are talking about the valuation of inventory. One has to do with the purchase price. For instance, we are talking about the Sierra Juice, the mango we are going to buy, you know, we need to account for the cost. And also, if we're talking about the conversion cost, the process that we are going to use to convert the mango to juice, the blender, for instance, that we are going to put the mangoes to ensure that we have the juice, then we can use that conversion cost as well. And also, the all directly related cost to bring the mangoes into its present condition and present location, we can account for them. So these three categories, these three factors should be considered when we are going to calculate the cost of inventory. So now this is the breakdown of the components. For instance, we are talking about the cost of purchase. It means the purchase price of the mango. If we are going to pay any import duties or taxes for the mangoes, we are going to account for it. If you're going to talk about the transportation and handling cost, and also if we have any discounts in terms of trade discounts or rebate, then we are going to deduct it from this cost to give us our cost of purchase. So now we are going to talk about the cost of conversion, which is very important. When we're talking about conversion, it can mean we use the direct labor to transform the mango to juice, the direct material. Also, we are talking about the production overhead, and when we are going to look at it in detail, we are going to look at the fixed overhead, which we can allocate depreciation or the factory rent. For instance, we rent a building which we use specifically for the production or for the conversion of the mango to juice. Then it means that rent we are going to pay, the depreciation on the machinery or the blender that we are going to calculate, we need to include it as part of the production overhead. Also, we have some other indirect material overhead and labor, which we can allocate to the fixed overhead. So also we have a different allocation method which we can use based on the normal capacity, and also when we are talking about the conversion cost for abnormal waste, costs are not included in the inventory valuation. So we need to know these guys, and when we are going to solve past questions, we can see how we can extract the cost component. Also, we are going to look at other costs, only included if necessary to bring the inventory to its present conditions. Example, we can talk about the design cost for a specific customer. For instance, if we want to brand the product, we want to write a unique name on the plastic for the Sarah juice, all these costs should be included. The transportation to production site is very much important. We purchased there, we bought the mangoes from, let's say, from the provinces, then automatically we need to pay transportation to the production sites. So all of these should be included as part of the cost of the Sarah juice that we are going to produce. And also we need to well aware of costs that we can't include as part of the cost of the inventory. For instance, we are talking about the storage cost. We are not going to, unless if the storage is for specific during the production process, then automatically we can account for it. But if the storage cost is general, we can't account for it as an inventory. Also, we are talking about the administrative overhead not contributing to bringing inventory to its present state. For instance, the fees that we are going to pay to the accountant for doing the debit and credit, another administrative tax, we can't, include this cost as part of the cost in the valuation of inventory. Also, the selling cost as well as the abnormal, waste costs. So we are going to look at the method in which we are going to value our inventory. We have three major categories that we are going to use: the unit cost, the first in, first out, FIFO, and we are going to use the weighted average method to value our inventory. So, and we also need to aware of the valuation method. So now we need to understand where items of inventory are not ordinarily interchangeable. For example, if we are talking about the used car, IS2 requires that the actual unit cost valuation method to be used. So we need to know the situation where we are going to use the unit cost, where we are going to use the weighted average, and where we are going to use the first in, first out. So if the inventory are not ordinarily interchangeable, for instance, the used car, then IAS2 requires we need to use the unit cost to value this particular inventory. Such items should be shown at their actual individual cost. We need to note it down. So where items are ordinarily interchangeable, for example, tins of beans, right? So this entity must choose between the two cost formula, whether we can use the first in, first out method, or we can use the average method, which is very important for us to understand. Now, the key concept about which method to use and which method we can't use is the interchangeable. So you need to note it down. The same method of arriving at the cost should be used for all inventories having similar nature and use to the entity. For inventories with a different nature or use, different cost method may be justified. So it all depends on the purpose, the use, and how the interchangeable content of the inventory that we are going to account for. So now we talked about the cost method. Now we are going to look at how we can account for inventory for the subsequent measurement. We can only use the concept of IAS2, which stated that inventory should be valued at the law of cost or the net realizable value when we're talking about the subsequent measurement. That's the time we have the option. But for the initial measurement, we need to account for it using the cost model. Thereafter, we have the option to either use the cost model or the net realizable value, the NRV, depending to the lower. So the basis is that we need to prevent the overstating of assets as well as profits if the inventory value falls. So now the concept is telling us that if the NRV, is less than the cost, inventory must be written down, which is obviously. Then also we need to look at the reversal of written down, which we need to account for. If condition improve and the NRV increase, then it means we need to reverse the amount that we have accounted for, but only up to its original cost. The reversal should not result to a gain. It needs to be limited only to its original cost. So we need to know this concept. Also, let's look at illustration so we can able to have a feeling of what I've been, talking about. So, for instance, for A, if we are talking about material cost 12,000 bots for processing and assembly for a profitable special order, since buying these items, the cost price has fallen to 10,000. So now, if we are going to account for the inventory, the cost that we are going to include as inventory, then it means we are going to use 12,000 units. The, let me do it. So we are going to use 12,000 units. Sorry, we are going to use 12,000 units, and then $12,000. Sorry, $12,000 will be the cost, while the $10,000 is not included because it is not relevant. So now, um, let's look at the example B, illustration B. Equipment constructed for a customer for an agreed price of $18,000. This is the price that for a customer. So it means if we are going to account for for the inventory at the low of cost or net realizable value, this should be considered to be the NRV. So this has recently been completed at a cost of $16,800. So this is the cost component. We have the net realizable value, and we have the cost. It has now been discovered that in order to meet certain regulation, conversion with an extra cost of 4,200 will be required. The customer has accepted to the customer has accepted partial responsibility and agreed to meet half of the extra cost. So it means from the NRV, half of the amount we are going to pay. Now we need to calculate the low of the two. So the cost is equals to the 16,800, while the NRV equals to the 18,000, the constructed cost, minus the half we are going to pay, to the conversion cost. So we are going to divide it by 2. So we have 4,200 divided by 2. So the answer will be, let me use my calculator. It will be 4,200 divided by 2, which is 2,100. So 18,000 minus 2,100. So therefore it will be 15,900. So basically, we are going to use the law of the cost or the net realizable value. So the value of the inventory, value of inventory equals to 15,900. So this is what IAS 2 is saying. So now we are going to look at inventory recognition in the financial statement. An inventory is shown under the current assets, as we all know from the SSS level, the senior school level, and also expenses relating to inventory include cost of sales, the write down, the reversal of impairment as a reduction in the cost of sales. So this is where we are going to treat the write down, the reversal, as well as all other costs that relating to inventory. Basic, it's simple. So now you're going to look at disclosure. You know, inventory is not much um, difficult. We just need to be careful of how we can account for the cost loaded. So now we can look at the disclosure requirements. Entities must disclose the accounting policy, the cost formula that is used to determine the value of the inventory, the carrying amount of the inventory. We need to disclose it in the notes to account. Inventory recognized as expenses. We need to show it. We need to show the write down on the reversal, and also we need to show inventory pledge as security. And we need to show breakdown of inventory categories, raw material, finished good. So these are the categories that we need to disclose. We need to show in the notes to account when we are preparing our financial statement. So I have few questions from the kit that we are going to solve during our live online, you know, um, session. I'm not going to solve any question on the recorded video. So now the important thing that you need to take home with you guys, you need to know the distinction of the inventory as I explained, and also you need to know how you can value your inventory. The law of cost on the net realizable value, especially when it comes to the cost, you need to know the components that should be included as part of the cost of the inventory and the component that should not be included as part of the cost of the inventory. Very important concept that you need to know. Now let's look at some of the kids questions, then we can see how relevant. For instance, looking at question 3, Mario has incurred the following cost in relation to the units of inventory. We have material cost, we have input duties, direct cost, subcontracted labor cost, recovery sales tax, storage cost, production overhead per unit. The question is, at what cost should Mario value this inventory in its financial statement? So if you don't know the component of cost that we need to include as part of the cost of the inventory, then you won't be in a position to to solve this particular objective test questions. So very important concept that you need to know, and also you need to know how the disclosure requirements it might be tested in the examination. So thank you very much for your time.